Keep the conversation going because we got big banks really driving the market action here this morning. But we also got another piece of econ data out that is really the focus here for the markets, it seems, with just about 20 minutes to go until the opening bell. And that is the producer price index coming in slightly hotter than expected in the month of June, rising about 0.2% on a month over month basis. That was more than what the street had been expecting in terms of that 0.1% growth forecast. Here to discuss, we want to bring in Steve Sosnick. He's Interactive Brokers Chief Strategist. Steve, it's great to have you. So I think my question to you is when you take a look at the reaction, especially what we're seeing in yields here ahead of the open, it looks like it's pouring some cold water on some of the enthusiasm we have for that CPI print this week.
Yeah, we got excited yesterday. I guess there's an old saying, buy CPI, sell PPI. I don't know that it always holds, but in this case it did, at least from the bond trader's point of view. This is what we're going to see is it's not necessarily a linear path. Disinflation is not necessarily a linear path. None of this is a linear path. You have your ups and downs. I think what was interesting was even despite some easing energy prices that have probably since started to reverse since the last reading, but that the headline number was up even as the core was up. So that's telling us that inflation is still coursing through the system in certain places. And the Fed is going to have a challenging job at their meeting at the end of this month because it's clear that the labor market is experiencing its own version of disinflation. I don't know what that is if you're growing more slowly in terms of employment, but at what point do they have to start shifting their focus? Powell alluded to the idea of, we have a second part of the dual mandate. It's not just inflation, but how are they going to wrestle with this and how responsive will they be? And will they be as responsive, I think, as the market hopes, because we're now pricing in pretty much a full shot at a September rate cut. When we think about where consumers and where producers ultimately are having to spend more in the goods versus services kind of calibration, if you will, and thinking about how much more people are spending on services or producers are spending on services as well here. What does that kind of net out to you? What should we take away from that, knowing that a lot of those services are things like shelter or even energy in some cases? Well, one of the things that struck me is we always get excited because earnings season starts with the banks. And I really kind of wish we didn't because the banks, we're talking about net interest margin and trading results and prime brokerage. I wish it didn't either, honestly. And it doesn't, because it doesn't really tell us what's going to happen for the rest of earnings season. Yes, you can read through Jamie Dimon and Jane Fraser and the like and their comments. Jamie Dimon, has been sort of like the human glass of cold water, essentially every time he speaks. But that's the only thing you really learn because no one else is really embedded in broad industry that way. The same, they're embedded everywhere, but their results don't necessarily show it. I thought Delta was more telling yesterday, and I think that was to me the kickoff of earnings season, and not in a very good way because what the story they told was really not a pretty one. What did you extrapolate about what they're saying about the consumer right now and how that could also be a thread for the rest of the earnings season? My concern is that the consumer is getting the consumer, the U.S. consumer is getting a bit more bifurcated. And I don't know where that bifurcation is. I don't know if it's the median income. I don't know if it's above the median, below the median. I'll leave that for some of the economists to really determine. But my concern is that we're starting to see the consumers, at least at the lower end of the income spectrum, get really stretched and get pressured. And that's not good for the economy. And that's why I want to hear from places like McDonald's and Pepsi and Coke, because they were crowing a few quarters ago about how they could pass on price increases to willing consumers. Now we're talking about $5 value meals and stuff. And so it doesn't necessarily affect the investment world quite so much because, quite frankly, the people who are investing are the people with the higher incomes. That's just it's just the way it is. But what it means is ultimately the economy does have to really respect what's going on with everybody because the consumer is 2/3 of the economy and everybody needs to buy staples.
So, Steve, I'm curious just to get your thoughts on some of the movement that we've seen in the market this week outside of some of the econ data prints that we've gotten, and even outside of earnings season. We did see a bit of a rotation, at least yesterday, in terms of the underperformance of a handful of those Mag 7 names. We started to see small caps outperform. Do you think there's anything to that just in terms of a shift in momentum, or is that more of a one-off type of trade, do you think?
I think both. I think yesterday's reaction was a bit extreme, but what it tells me is I've been one of the people who've been advocating for rotation and getting concerned that we've been on an ever narrowing. I've called it stock market Jenga. We just keep building it higher and taking little pieces out of the foundation as we go up. But the problem is, I wonder if we've gotten a little unsustainable on that one, because yesterday, if you looked at advanced declines on NASDAQ and NYSE, they were sharply to the advancers, but the wrong stocks went down. And the problem is, if that persists, if it's a one-off, it just happens. If it persists, when people are putting their money into an S&P 500 fund, whether it's spiders or an index fund or whatever, they're expecting diversification, but really more than, call about 35% of it is basically in the Mag 7 plus Broadcom. And that's not a lot of diversification. And so if those stocks fail and there's no one to buy that dip, people then will freak out because they'll see the S&P 500 going down, they'll see the NASDAQ 100 getting thrashed. They have spies and cues. They don't necessarily respond to the idea that, oh wait, there were 3,000 advancers to 1,000 decliners. It's less relevant to them.
Who knew that when we were talking about the broadening, it would really just be Broadcom that we would add on to Mag 7 here. Steve Sosnick, thanks so much for taking the time here this morning.
Thank you, Brad. Thank you, Shauna.